Federal Reserve has opened the door to corporate bond purchases. Is this the start of a new leg up for the equity markets? As we saw when they made the announcement. IG's chief market analyst Chris Beecham joins us now for today's IG Trading the Markets podcast. Chris, welcome. Were you as surprised as I was when the Fed did what they did 6 months ago? We were talking about the lack of options for central banks, and all of a sudden they seem to have tapped into possibly a new avenue of opportunity for these equity markets. We saw the markets rise on the day of the announcement. Is this a new chapter, do you think?
Yes, it is really. In some ways, it borrows from the Bank of Japan's policy over the last 20 years or more. It does seem incredible to think back to a few months to how we were discussing the Fed was at the end of its tether in terms of operations, and it really does prove how there's always more that central banks can do, and underestimating them, particularly underestimating the Fed, is a very bad idea. I think there was a sense back in March, even as the crisis really got underway, that the QE programs that they had announced and the cut in interest rates would be the limit of their activity. But the message from Powell over the past 2 months, and underlined by the activation of this market purchase scheme this week, has been that the Fed can and will do more to support the recovery. And people should be very cautious about assuming that the Fed is out of ammunition, as the phrase goes. This was the mantra at the end of last year. There's nothing more the Fed can do. Well, we've disproved that, and equity markets clearly find it to be a positive. Not just because the Fed is trying to prop up those equity markets. That's not its aim. This is a side effect. And I think people mistake the side effect for the intended consequence. I think it's more a case of putting confidence back in the economy. In the case of these corporate bond purchases, of course, it means that US companies can now borrow more and engage in normal activities, really, without fear of seeing buyers dry up, without fear of seeing their credit ratings being downgraded. And I think it's all about the Fed doing what it can to tide everything over until such time as a degree of normality really returns to the US and indeed the global economy.
You mentioned the fact that Japan have been doing some of this in the last, 20 years or so. I think the Japanese have been in the equity markets, but they've been buying equities outright, haven't they? This is buying corporate bonds to support the corporate bond market. Do you think ultimately the Fed could actually enter the equity market and become a large holder of US equities?
I think if the crisis worsened noticeably, then yes. It's a bit like negative interest rates. The Fed has said they're firmly off the table. I think I believe them until otherwise. Um, the Fed has to do what it can. Really, they are haunted by the lessons of the financial crisis. They're haunted in many ways still by the Great Depression and policy failure on a massive scale that unleashed economic misery for millions. I think the risks of the coronavirus crisis are similar, really, and that's why you've had the Fed, BOJ, the ECB, the Bank of England, all moving in this way in a far more dramatic way, and crucially in a far quicker way than we had in 2008. We saw the lessons from 2008, and the lessons were that you need to do this and you need to do this very quickly, and that's exactly what they've done. But we should not assume again that just because they've done a lot more and gone a lot further than where they were, say, a few months ago, that that's the limit of their activities. As you say, the BOJ has been in the equity markets purchasing equity ETFs for a long time now. It could be, if push comes to shove, that the Fed will do what it can in that area too. I think that the message though from the Fed that recently, certainly if you look at Powell's testimony to Congress, has been, well, we've done what we can, but ideally it's now time for governments to step in and do the fiscal side of the equation to provide the additional support that takes everything a step further.
Is this not a very dangerous situation, though? Because many are suggesting we could well see COVID-2, the second wave of the coronavirus, and many are saying that if it follows previous pandemics, the second wave is far worse than the first. If that's the case, surely we got another large correction coming in the equity markets, don't we? That certainly seems to be the common thinking amongst many who are commentating about the situation at the moment.
I think we'd have to assume that the second wave would be worse and a lot worse to really cause a similar situation in equity markets to what we had in February and March. Markets don't like surprises. They can deal with things like trade wars and indeed Brexit once they've got used to it, because they can start to price in the second order effects of these. Nobody at the beginning of the year, or at least nobody that I read, had global pandemic as a list of major risks for 2020. Certainly not the standard run-of-the-mill outlooks for the year. Would have no one in their right mind would have said there'll be a major pandemic that sees a shutdown of almost every major economy across the globe and cause the complete ending of global travel on a temporary basis. I think for markets to react in a similar way to what we had in Q1 would need a much, much bigger second wave. And I don't think, famous last words, but I don't think that will happen, because we know in some ways that the policy solution is lockdowns on a huge scale, and that will be re-implemented again if it becomes necessary. We've seen a bit of that in China with its cases in Beijing. They've locked down schools and essentially shut the city off for the time being in order to stop the spread. The big worry, I suppose, for the US is whether it's even got over its first wave is the first debatable point, but certainly the second one is in an election year with everyone eyeing their poll ratings. Will they be quick enough to lock down to prevent that second wave from getting much, much worse? But I still think it will have to be a lot worse, because now people know how these things can be dealt with. They know that the impact can be mitigated. And also, we are further down the road in terms of treatments. We may not be at a vaccine yet, but we're certainly heading in that direction. We've had plenty of positive news over the last couple of months that provides us a suggestion that we are moving in the right direction, at least to mitigate, again, that key word, the effects of a renewed wave of infections.
Just wanted to catch up as well, going back to the central banks and touching on what the Fed's done, and ask a question about the Bank of England this week. I think I'm right in saying that the Bank of England initially had something like around about 10 billion of QE within the corporate bond market. What is the Bank of England likely to do this week? And do you think there will be a widespread adoption of the strategy that, as you say quite rightly, was initiated by Japan all those years ago, and now the Fed's picked it up with this corporate bond purchase? Do you think that's going to be the new wave within the markets, is central bank buying from the European Central Bank and the Bank of England in a big way in the corporate market?
Yes, I think it is. I think this week we should see the Bank of England cut rates to almost zero, if not zero entirely. And we should see at least an extra 100 billion, or maybe even more, really, in terms of bond purchases, because the BOE knows that with existing programs planned to run out in July, it needs to do more, because we are only really at the beginning of the economic effects of this crisis. I think that, the ECB has gone down that route in terms of bond purchases. I think that the Bank of England could do as well. Because I suppose if the Fed does it, you have to do it as well. The essential truth being that where the Fed leads, everyone else tends to follow. The BOE, I think, will also go down that road. It will do what it can. It will help the government by, I suppose, in a sense, keeping borrowing costs low. It will help the corporate sector by trying to keep its borrowing costs down, and just provide the kind of environment where companies can keep running, even at very reduced levels, so that, again, if and when things return to a stage of normality, then they can slowly begin to ease back from that support. But like any crisis, we're still living through the ramifications of 2008, 2009, and we will live through the ramifications and the after effects in terms of policy of this crisis for quite some time to come.
If and when. We'll leave it on there, but let's hope that it is soon that we can get to some sort of normality within those markets. Chris, thanks indeed for joining us. That's Chris Beecham, IG's Chief Market Analyst, for today's IG Trading the Markets podcast. And please do subscribe to our regular updates once a week. For more videos from us here at IGTV, join us on Twitter at IGTV and subscribe to our YouTube channel.